Now, following on from our last video on the change to stamp duty, I want to talk briefly about the second proposed change which will affect the buy-to-let landlords. Let me start by saying that this change has been criticised heavily, with challenges underway from landlord groups and agents who claim the proposal is unlawful. Now, if it does go ahead, the new rules commence in 2017. Let me try and explain exactly what could happen in a year's time. So right now, if you own a buy-to-let property which has a mortgage, you're able to claim back all the interest you pay as an expense, and so you only pay tax on the profit after interest. Now let's take a look at this in practice. Today, a landlord earns a salary of £43,000 and they rent a property out on a buy-to-let mortgage. Their rental profit after they've claimed back the mortgage interest paid is £6,000, so their total income is £49,000. In this case, the landlord has a total income tax bill of £7,400. Now, George Osborne says this is unfair because buy-to-let landlords have a huge advantage in the market as they can offset their mortgage interest payments against their income, whereas home buyers cannot. And the better off landlord, the more tax relief they get. The new rules aim to level the playing field. The plan will be to gradually ease the amount of tax due over 3 years as follows. So year 1, 2017-18, the deduction from property income will be restricted to 75% of the finance costs incurred, with the remaining 25% being available as a basic rate reduction. Year 2, in 2018-19, 50% of the finance costs will be given as a deduction, with the remaining 50% as a basic rate reduction. And in year 3, 2019-20, 25% of the finance costs will be given as a deduction, with the remaining 75% at a basic rate reduction. So let's look at what happens to our landlord at the end of those changes. For the purpose of this, our landlord's salary of £43,000 has not changed. But the big change is their rental profit. Without deducting mortgage interest, now is £6,000 to £15,000, a big increase. Total income now liable for tax, £58,000. And the landlord's income tax liability has increased to £9,000. So that landlord's now paying an additional £1,600 in tax for this property. Now imagine this multiplied over 2, 3 or 4 or more properties. We're talking about a significant change to a landlord's yearly tax bill. Now this change will affect all private landlords who hold mortgages or other loans whose total rent and other income before that mortgage interest or other interest exceeds the 40% income tax threshold. Now the effect of this could be profound on those landlords who hold rental property portfolios with high level of borrowing, and if interest rates do increase one day, this will of course just make the problem a whole lot worse. All the details have not been ironed out yet, and there are some exemptions already being stated. The main one being landlords where property is owned in a company name who have over 15 units will escape the proposed changes. It's too early to say what the impact of this could be. Will it level the playing field for those young first-time buyers? Will it put some landlords out of business? Will it make buy-to-let property a less attractive proposition? Our experience has taught us that while there may be some made worse off by these changes, on the whole, the market will adjust. And if it comes into force, buy-to-let will likely remain as popular as ever. To catch more of these videos, why not subscribe to our YouTube channel or visit us at manningstainton.co.uk.